Hello everyone and welcome back to the channel. In today's video I'm going to talk about VDHG, the Vanguard Diversified High Growth ETF. This is part of a new series in which each week I talk about a different ETF. In this video I'm going to discuss exactly what VDHG is, its composition, its past performance, the advantages and disadvantages of it, as well as giving my final thoughts. This is an ETF that has gained a great deal of popularity in the relatively short time it's been available. If you've been on any Australian investment-based website or discussion forum in the past few years, you may have heard of VDHG. Touted by some as the pinnacle of passive investing, it has gained quite a bit of popularity in the Australian passive investing and FIRE community. But what exactly is VDHG? Let's take a quick look at that. If we think of an ETF as a collection of companies trading as a single fund, then VDHG is almost an ETF of ETFs, if you can think of it that way. Sometimes it's referred to as the fund of funds because it is 7 different Vanguard funds trading under one ETF. Each of these funds cover a different area and a different purpose within the ETF, and altogether serve to make it a supremely diversified fund. With the 7 funds on the screen, you have altogether over 10,000 different companies and holdings you're invested in, so you'll be very hard pressed to find a more diverse fund than this one. But what is each of these wholesale funds and what do they do? Let's talk about that now. So if we look at the screen, we can see we've got 7 different holdings, each with various weights. So starting from the beginning, we have the Vanguard Australian Shares Index Fund. Its ticker symbol in ETF form is VAS, and it has a 36.4% allocation right now. And basically, it's an ASX index fund. It tracks the largest Australian holdings, such as the banks, CSL, BHP, Telstra, and all those sort of companies. It's fairly stock standard index fund, and it is what it is. For the Vanguard International Shares Index Fund, again, that's a fairly sort of standard index fund that covers things on a global level. You'll find a lot of its allocation is based in US companies, a lot of the US tech companies being the larger companies, the trillion plus market cap sort of Apple, Amazon, Google, all that sort of thing. And it makes up around 26.1% of the VDHG composition. And next, if we move down, we have the Vanguard International Shares Index Fund, but this one is hedged against the Australian dollar. And what that means is when you're investing over a long time frame, sometimes currency can fluctuate quite significantly. Look at the Australian dollar, for instance. It's been anywhere from around 50 cents to over $1 US dollars in the past 20 years. So there's a lot of fluctuation. And it's good if the Australian dollar weakens against whatever holdings you have internationally, because it means you have more money in your currency. However, if the Australian dollar strengthens, you can actually be left going backwards. So the hedged portion is kind of counter to that and helps protect against those currency fluctuations. And the ticker symbol for this one is VGAD. And if we move down, we see some of the smaller holdings. We have the Vanguard Global Aggregate Bond Index, which again is hedged. It makes up 7.1% of the VDHG portfolio. And this is part of the fixed income section of the ETF, and something that is sometimes maligned by people who want 100% equities, but it is what it is. We move down to the Vanguard International Small Companies Index Fund, and that has a 6.4% allocation, and that's, you know, your lesser known companies, your up and coming sort of smaller cap companies which have obviously higher potential for growth, but again, higher potential for failure as compared with some of your more blue chip companies. And the ticker symbol for this one is VISM. And if we move down further, we have the Vanguard Emerging Market Shares Index Fund, another wholesale fund there with a 5% allocation. And this is where you get your exposure to emerging economies, most noteworthy being China. You have South Korea, you have countries like India, Russia, Brazil. And when you're looking at this one, you think of companies like Alibaba, Tencent, Samsung, those sort of prominent companies in sort of these up and coming emerging economies. And the ticker symbol for this one as an ETF on its own is VGE. And finally, to round things out, we have the Vanguard Australian Fixed Interest Index Fund. And this makes up 3.1% of the portfolio allocation. Again, this is part of the fixed income section of the portfolio, and pretty boring to say the least, but it is there. And with all this accounted for, we can see that VDHG has around a 90% equity allocation to a 10% fixed income allocation. And a lot of people have issues with this, and many people have successfully argued that 100% shares is probably the better way to go, and I certainly won't disagree with that. I think the primary reason for having sort of these fixed income assets in there is mostly for rebalancing sake, and I think Vanguard's logic there is just during a market dip or something like that, it provides a little bit of a cushion and a little bit of stability while being able to reshuffle and rebalance some of that fixed income into the aforementioned equities like your VAS and your VGS and all that sort of thing. And it's a relatively small complaint, but it's enough to turn some people off investing in VGHG. So what does all this mean for the ETF? Let's take a look now at the numbers, the performance, and what the heck all this means for us. So if we look at some of the key data, we can see that this fund is relatively new. The fund's inception was November 20th, 2017, so it is literally right around 3 years old. But in that time, it has managed to grow to a fund size of $524 million, which is quite respectable. That's about the size of Raiz's entire holdings, to give you some perspective on that. The management fee on this one is 0.27% per annum, which is a little bit higher than standalone options like VAS, VGS, or VGE, but it's the price you pay for convenience and having everything in one sort of package there. The distribution frequency is quarterly, and this one actually pays a fairly respectable dividend. You're looking at sort of, depending upon the year, anywhere from a 3 to 5% dividend yield, and that is largely due to the heavy Australian holdings via VAS, and you're going to find that the dividends are partially franked, so you'll get some franking credits come tax time. And as for performance, as mentioned, this one is only about 3 years old. So when we go here, we don't have a whole lot of data. For the 1 year, it's somewhat down. For the time since its inception, we get performance of about 5.68%. So the thing is, although this fund has only existed for around 3 years, we do have a very, very close proxy for it, and that is the Vanguard High Growth Index Fund, which for all intents and purposes is essentially the same thing. As you can see here, the holdings are basically identical. So if we use this as sort of a proxy to give us some historical performance figures, we can see that basically the same sort of figures over yearly, but we have more populated data with regards to longer term. For 3 years, it has yielded right around sort of the 6% mark. For 5 years, you're looking at about 7% range. And over the 10 years, you've got right around 9%. So it's dead bang on market average. This ETF, VGHD, is probably not going to set the world on fire. It is an incredibly average performing ETF, and that's its intention. It's not meant to be a fast runner like NDQ or one of these more niched down high growth options. This is supremely diversified, so you're not going to get focus on any one fast growing sector. This is something to be held for 20, 30 years and essentially gain the market average. So if we look at its predecessor fund, we can see that it has done that, and this Vanguard High Growth Index Fund that we're sort of extrapolating the data from has done just that. And this fund is nearly 18 years old. It was brought out in 2002, so it gives us a little bit of a sort of substituted historical performance for the VDHG ETF itself. But with that said, let's move on to sort of the advantages and disadvantages of holding VDHG. So if this fund has rather average returns, what are the advantages and disadvantages of it? So to start things off, the number one advantage of VDHG is its convenience. It's basically everything in one. You buy it, you buy more of it, and you keep buying it until you need to retire or need to draw it down. It is essentially all wrapped up in a convenient package for a person who may not be that savvy with investing. You get supreme diversification. You've got over 10,000 companies you're invested in, and no matter what, you're going to capture at least some of the growth around the world. And if there is a downturn in a certain part of the world, you're not going to be dragged down in entirety. You get automatic rebalancing of your portfolio, so that takes some of the emotion out of it. When people are subjected to market crashes, they tend to do stupid things or go with their heart rather than their head, and this sort of takes that decision-making process away of when to rebalance and when to shift funds around. Vanguard sort of does that all for you. You can set up dividend reinvestment, which a lot of people will often choose to do when they are accumulating wealth and building towards drawing down eventually. And yeah, it's essentially a very convenient wrapper all-in-one portfolio. But with that said, being an all-in-one option brings disadvantages. It's a little more expensive than buying the constituent ETFs. The management fee is 0.27% per annum, whereas the management fee on something like VAS, the Australian shares, or VGS, is half of that. And even if you wanted to assemble a portfolio using the same constituent ETFs available, you could do it cheaper. I think it's about 0.19 or 0.20 per annum if you do it standalone, but you don't get the automatic rebalancing and all that sort of thing. With buying a pre-packaged option like this, there's no customization. You're essentially at the whim of Vanguard to adjust your allocations and set things up as they see fit. And for more savvy investors, people who are more experienced, they may want to have an alternate option. A lot of people opt for 50% Australian shares, 50% international shares, or they may add the aforementioned 2+ emerging markets, and sometimes they want to shift those allocations around, and that's fine. And also, as I mentioned, the diversification, while it's an advantage, can be a disadvantage too. While you're not going to get taken down into the abyss when something crashes, you're not exactly going to be dragged up to the sky either. Just because you're so diversified, you're going to get dragged down by the things that are not performing as well. So this will always be sort of a mediocre performing portfolio. This is not going to be your high flyer, sector specific ETF that does 40 or 50% a year. This is going to perform as the market does as a whole. This is a very macro scale investment on a worldwide scale, and your growth rate's going to reflect that. And last, and maybe the largest grievance that people have with this one, is the bonds. People hate the bonds, and a lot of people will argue, quite successfully too, that the bonds are not needed, and I tend to agree. I think for somebody who's on the younger side, going with 100% share portfolio is probably the more viable option. I think the bonds are just there mostly as a rebalancing tool, but they can drag on performance, and people who are very savvy with investing and want to take more personal control are going to want to optimize their portfolio more for growth, and taking out those bonds does become an issue. So with all that said, I'll move on to my final thoughts. So to sum things up, the Vanguard Diversified High Growth ETF, the VDHG, is, in my eyes, the Toyota Corolla of the investing world. It is not as flashy or as sexy as a Lamborghini, but it's practical, it's cheap, it's easy to use, and suitable for 99% of people. This ETF doesn't have anything sexy about it at all, and that is totally fine. It is well diversified enough that no matter what transpires, the ETF will capture growth in any part of the world. More seasoned investors will likely favor a custom mix of VGS, VAS, and VGE, with lower fees, no bonds, and more choices to allocations. But for the common person, for someone who doesn't know much about investing or just wants a fire and forget option, this is about as good as it gets. This is about as close to perfect as you're going to get for a one-size-fits-all. You pick your brokerage, you choose if you want to set up dividend reinvestment, you make sure you do your taxes each year, you add money to it until you're rich. Simple. And you do that over 10, 20 years. Well, most people are going to add it to their share site portfolio and check it 20 times a day, but I'm on to you, but that's fine. This is something that if a family member or something or a friend came up to me and said, I wanted one thing to invest in and I don't really know what I'm doing, this would be something that I would encourage them to check out. It essentially takes the thinking process out of investing, and for many people who don't have experience investing, it's probably better to leave your investing decisions in the capable hands of Vanguard. I mean, Vanguard's reputation speaks for itself. They've been around for decades and they are one of the pioneers of passive investing in index funds. So as a company, they're very, very trustworthy. They're going to be around for a long time. I believe they're the second largest in terms of asset management behind BlackRock, and when I say they manage a lot, they manage in the trillions of dollars. So Vanguard is not going anywhere anytime soon, but I hope this video has been informative and helpful for you guys. If you feel so inclined, please do chuck it a like and subscribe if you do feel that it deserves it. I'm going to try and cover a different ETF each week, so I'll be looking forward to your comments down below, and if you have any suggestions for future ETFs, I'll be happy to cover them and go into them in some detail. But with all that said, I'm just going to say my name is Rich, and I hope you all have a great day.